This video is about the difference between accounting and finance. I'm making this video because there's a lot of confusion out there about the difference between these two roles. A lot of people in business don't know the distinction. In business school, in a lot of business schools, these are two separate areas of study. So you'll go to business school and you'll either learn how to become an accountant or you'll learn how to become a finance person. And they use two different tools and skill sets on how to accomplish their goals. So I think it's important to understand the distinction between these two areas. Now, in this video, I'm going to talk in pretty large generalizations. Every organization is different, so this isn't going to apply exactly to everybody's organization. But in general, when we talk about the accountant role and the finance role in an organization, I think it's useful to understand the distinction. So in general, what makes the difference between an accountant and a finance professional? Accountants are primarily concerned with the goal that is historical looking. This is different from finance because in finance, the goal is future looking. So what does that mean? Well, let's start with accounting. So accountants, their goal is to create a set of financial statements that represents accurately the financial standing of a company at some moment in time. So they look at the economic transactions that have occurred up to this point. They look at how much cash is in the bank today, and they say, how did we get here? And they create a set of financial statements that accurately represents that. Now, this is easier said than done. And accountants deal with all kinds of really complicated problems, and they found ways to solve those problems. When you have a really complicated organization, you have hundreds of employees and thousands upon thousands of transactions, you get all kinds of errors, you get returns in your sales, you make sales that might have returns in the future. You have all these complicated situations, and accountants have ways to represent those accurately and do it in a way that's standardized across the nation. So you can take accounting statements from two different companies and make investment decisions. Finance, on the other hand, has a future-oriented goal. So finance people start with the financial statements from the accountants. They say, okay, this is how much cash we have in the bank today. This is how we got there. What are our assumptions about what's going to happen in the future? And then they take those assumptions, and that informs the business decisions we make about how we're going to use the cash today. Why this is important is because there's two different goals, that informs two different definitions of risk. And it's funny because when you get an accountant and a finance person having a conversation about risk, it's almost like they're talking about two different things. And it's because they are. When an accountant talks about risk, they're concerned with the risk of material misstatement of the financial statements. So they're concerned that somehow something's not being accurately represented. All these things historically have actually happened, and the accountant's job is to represent them. And so that's the risk that they're concerned about. And they're always trying to minimize that risk as much as possible. Finance people have a little bit of a different relationship with risk. There's a little bit more of embracing risk in finance because finance deals with the future. It hasn't happened yet. Nobody can predict it 100% accurately. So there's always going to be an element of risk there. Their definition of risk is what's the variance between my assumption about the future and what actually ends up happening. That's the risk that they're concerned about. And this risk is really important to a finance person. If you remember from my earlier video on the time value of money, risk plays a really big role in determining valuations, because based on the risk that you're assuming, that plays into how much you should be compensated for holding that risk. The higher the risk, the higher the return. So for a finance person, it really becomes about managing your risks. So these are two very different conversations, and they come with two very different skill sets. Now this is in the context of a corporate environment. Probably the biggest area of finance deals with investing. Investing is its own unique area of finance, but it's really kind of the same situation. Investors, they're looking at different companies, and they start with the financial statements from the accountants, and they say, this is how much cash is in the bank, this is how the companies have performed up until this date, what are my assumptions about the future, and where am I going to put my money to get the best impact in performance in the future? So that's investing, and that's a specific area of finance. But in the context of an organization, what I want to emphasize is that both of these roles are incredibly important to have a strong skill set in. So most organizations have kind of a similar setup where you have the CEO at the top, underneath him you'll have the CFO, and under the CFO you'll have the head of accounting and the head of finance. The head of accounting might be the controller. Every organization is different, but that's a pretty common setup. But for a business leader, for that CEO, it's really important to have both of these skill sets, because the business leader needs to understand both what has been the company's performance historically up until this point, and what's the understanding of how to get the best performance in the future. What business decisions need to be made today that are in the best interests of the company? So both of these skills really play into that. So to recap, we talked about the difference between accounting and finance. They have two different goals. Accounting is focused on the historicals, whereas finance is focused on the future. And because there's two different goals, that informs two different definitions of risk.